Hello everybody, and today I wanted to talk about home office expense deductions and audits, IRS audits as associated with those. Again, I am a CPA, I'm a licensed CPA with just about 2 decades of experience, and these are some of the questions that have popped up throughout my career as well as with some of my clients today. So the first thing that I want to cover it as well with under the home office deduction is who can take it? What is this actual expense? So this is an expense that you can take if you utilize your home office for business use. Now there are specific requirements in order for you to be able to take this deduction, and I'll get to the specific requirements as we continue through the video. So if you have a space in your home that you utilize for your home office, you may be eligible to take a deduction for those expenses. Those expenses include rent, if you rent your home, mortgage interest, real estate taxes, utilities, repairs, as well as any other expenses that may be associated, within your home or apartment. So let's kind of get into a little bit of specifics. So I think the number one question that I end up having, especially since COVID, there's a lot of people that are living at home, and a lot of questions that I usually get is, "Hey, I paid a lot of money for internet or other associated expenses that required me to work from home." So if you're an employee, which an employee would be defined as you receive a W-2, you receive regular wages from a particular employer, you are not eligible to take this deduction. Regardless of you working from home full time, having to pick up expenses, so such as internet, electricity, those sort of things, or even having to buy monitors or connections, cables, whatnot, none of those items are in fact deductible. There were items that were deductible prior to the Tax Cuts and Jobs Act, and that started in 2018, and those were able to be deducted under the unreimbursed business expenses under Schedule A. So if you itemize your deductions back then, you would be able to go on ahead and take some deductions for any unreimbursed business expenses being a W-2 wage earner. However, those items were suspended back in 2018, and they are suspended until 2025. So again, we might be able to see this peering its head once again, and we might be able to take those deductions once again, but there is no specific guidance yet, as the tax law is going to be scheduled to be changing in this up and coming year, especially with a new administration coming in, and several tax provisions that are looking to sunset at the end of 2025. So I do definitely anticipate there to be changes. This potentially can be one of them, so we'll just keep this on our radar going forward into the future. So again, if you're a W-2 employee, this does not pertain to you. Now, if you own your own business, if you own your own business, you're freelance, you have a side gig, and you utilize a portion of your home for this particular business, whether it be your main source of income or secondary as a side gig, and you file a Schedule C, you may be eligible to take this deduction. So again, as I mentioned, you can write off utilities, real estate taxes, repairs, maintenance, and other related expenses to your home. And it doesn't necessarily have to be a home. I mean, you could have your, say the primary area is a boat, or it's a apartment, or it's a detached area, on your house, like a garage. Again, depending upon the method will definitely depend. So let's kind of talk about some specific requirements, because the IRS does have specific requirements in order for this to be considered use of your home office, or considered to be a home office expense deduction. So basically business use of your home. So under the rules, you must exclusively, on a regular basis, as your principal place of business, use your home office for business. So basically what that means is, so I'll kind of go through it, and then let me go through the specifics of the IRS, and then I'll kind of explain it in a little bit more detail to put it in clear English. Exclusively on a regular basis as a place to where you meet or deal with patients, clients, or customers in the normal course of your trade or business. A separate structure that is not attached to your home, used exclusively on a regular basis in connection with your trade or business. On a regular basis for storage of inventory or product samples used in your trade or business of selling products, retail or wholesale, as long as your home is the sole fixed location for such trade or business, for rental use, or as a daycare facility. So let's kind of get into a little bit more details on basically what that means. So let's just say hypothetically, let's use a CPA as an example. Say I had an office, and the office wasn't in my home. I rented office space separately that was outside of my home. And then I do some work as well outside of my home. Well, under this definition, it has to be my principal place of business. So if my home is not my principal place of business, it's not primarily where I go, seek, meet, and do my work with clients, I would not be eligible for that. So it has to be your principal place of business. So this means that I shouldn't have any other, location, anything else. I shouldn't be taking rent expense deduction on my return on the separate line in the Schedule C. That will be something that the IRS will look for, and we'll get into the audits a little bit later in the video. So again, that requirement right there is one of the more, I shouldn't say it's more difficult, because for a lot of people are doing freelance work and side gigs and side hustles, especially with social media and whatnot. So, if you have a space in your home, an office, that basically you don't use it for anything else, you have your whatever you need in there. If you don't meet with customers, that's fine too. You're still able to take the expense. It really just depends upon what your principal business is. So if it's like graphic design and you have your computer and your laptop, and then literally all you do, and you have a printer or whatever else that you need for graphic design, and that's in a specific room in your home, you can utilize that space. And similar, if you have like a detached shed or an attached shed, and you are selling, let's just say you're selling lumber, and you use that space to store your lumber, and you don't have another location. Again, you could take your home office expense deduction from there, but it has to be exclusively used for business expenses. So that is one of the key words here in order to make sure that you are eligible for this particular deduction. So let's get down to it. A little bit more information on the credit is that there's two different methods, and there's pros and cons to each method. There is what's known as the regular method and the simplified method. The regular method is a method in which you take the actual expenses of your home. So, you in this method, you're also required to take depreciation. So, what that means is you depreciate your home 27.5 years. And we'll get to kind of the pros and cons of that as we progress in the video. So you take your actual expenses. So if you own your home, you'd be able to take your mortgage interest, you'd be able to take your real estate taxes, your utilities, repairs on the home, any other, any sort of, anything that's in the normal course of business that you would take under that specific, business profession that you have. So those would be the actual expenses. Here, if you're going to take this method, you're going to want to make sure that you're maintaining receipts. Receipts are definitely important. Now, obviously, for utility bills and whatnot, that's less important because, let's face it, you're going to need electricity for your business. You're going to need internet for your business. You're going to need gas or oil or heat, however you heat your home, for your business. So that is a pretty reasonable item. So you don't necessarily have to substantiate that as much. It's really when you come into the other deductions. So if you're going to start taking deductions for a renovation to your bedroom, that would be something that I would probably exclude from it because, again, that's not necessarily a direct repair to your office or a direct fix to your office. Now, if you painted your office or, something along those lines, then yeah, by all means, you can go on ahead and take that repair. But the gray area comes out is when you're doing repairs to personal spaces on your home. You're going to have to substantiate that there was a percentage that was associated with your business. In the event the IRS audits you. Now, not to say that people don't take overall repairs to their home because, I've definitely seen it before. But, again, the technical rule behind it would be it should be associated with your office if you're talking about repairs. Another big thing is decorations, like home decorations. A lot of times people will try to take, you buy stuff at a Marshall's or a TJ Maxx or Pottery Barn, and you decorate your home, and those are in your personal spaces, and people will try to take that as a deduction, and then that's frequently disallowed by the IRS. So again, kind of keeping receipts, and then also keeping in mind what is reasonable, because the IRS is also going to look for reasonableness as well. So if you don't see customers, it's not really reasonable to say I'm going to put an office decoration in my office. So just kind of keep that in mind. The second method is a little bit more simple. This method is known as the simplified method. Now, this is the safe harbor method. So basically, it's a flat rate of $5 per square foot of up to 300 square feet that you're able to take as a home office deduction. So both methods, so to kind of clarify a little bit, both methods, you actually have to state your square footage of your office and then total square footage of your house. So if we take an example of saying the 300 square feet and your total home is 1,000 square feet, technically you utilize 30% of your home for your home office expense deduction. So you'd be able to take 30% of your mortgage interest, 30% of your real estate taxes, 30% of your utilities, etc. Now, again, here's where reasonableness comes into play, because depending upon your industry, it may not be reasonable that you're going to take a 30% deduction on all your home expenses, or that your office occupies 30% of a 1,000 square foot home. So again, it has to be reasonable. And the key here, like I always tell customers, is it's got to be a reasonable amount. So, like it's not going to be reasonable that your 75% of your home is used, or 50%. It's probably more reasonable that like a 10%, more in the 10% range is utilized. And I think kind of somewhat sticking within that smaller percentage, because it's going to be more reasonable that's going to be one particular room versus multiple rooms. So again, sticking with a smaller percentage. Some pros and cons. So the simplified method, obviously you don't need to keep any receipts. You just simply take whatever the square footage is of your office, up to 300 square feet, multiply that by the $5, and then that's your particular deduction that'll go on your Schedule C. And then you can still take any of your normal personal expenses, so your mortgage interest, your real estate taxes, on Schedule A if you itemize. On the regular method, you do have to take depreciation, so you are going to have to figure depreciation on your house. Now, what this brings an issue, because when you go to sell your home under the regular method, you potentially can disallow some of the exclusion of gains on primary residence, on your personal residence. That's $250,000 per person. So anything that you've already depreciated and utilized for business use, that percentage will end up getting eliminated from that gain exclusion. So you will probably have to pay a small amount of tax, or some tax, depending upon how much of your home you depreciated over the years when you actually go to sell it. So that is, again, something to consider, because during a normal person who does not take this home office expense deduction would not have to exclude any portion of their gain, up to $250,000 for single individuals and up to $500,000 if you're married. So basically each individual has $250,000. Again, that's the tax law as it stands today in 2025. It can change again in the future. So that's just something to consider. That's probably the biggest item to consider, as well as receipts. You're going to have to keep receipts to substantiate your business deduction. So the event the IRS comes in and says, okay, substantiate this home office deduction, you got to take receipts. And they may ask you to substantiate the room that you're claiming as your home office deduction, to kind of show like, hey, what are the dimensions and whatnot, just to be able to say this deduction's a legitimate deduction. So again, like I said, keep things reasonable. And I always suggest to people, especially something like this, exercise on the side of caution. Don't exercise, don't be aggressive on it, because if you're aggressive on it, you're ultimately going to end up, potentially could ultimately end up in an audit situation and they disallow the expenses, which then would result in interest and penalties on any balance due of items that they disallowed. So pretty much the way the IRS works things is, if they'll say to you, prove this to us, and if you can't prove it, or if the IRS agent does not have reasonable suspicion to believe that, hey, this is a legitimate expense, they'll give you a rationale and say, nope, sorry, this is disallowed, and then you would just owe the difference of money from it. Again, typically you don't get a huge deduction on this, but every little bit counts. So kind of keeping in mind that it's based off your total percentage of your house if you're taking the regular method. So square footage of your office divided by total square footage of your house, that's your percentage. That's what ends up getting deducted. So let's kind of talk about audits. So we can talk about audits somewhat in general, but let's kind of talk about audits in relation to this. So really the IRS does not really necessarily have a set procedure for picking people for audits. So, they have a lot of things they use as two different methods. So one is really a random method. So typically the random method is more or less higher income individuals. And then the other method is trends. So trends would be, both thinking it from a personal basis as well as from a business expense. So from a personal basis, they're going to take your deductions in relation to your percentage of income. So, probably a big one would be charitable contributions. It's not reasonable that somebody gives 50% of their total income in charitable contributions. So that would create a red flag. Similar to a business, they ask you to put your principal business practice on your Schedule C, as well as the NAICS code on your Schedule C. And again, that's why it's important to make sure you review and read all through the codes and make sure you select the correct code, because they're going to take all the data from everybody that submits the returns as well as industry data, and they come up with what is a reasonable amount, or what's the average amount. So again, if you're way over the average amount, if you're way below, it's not a big deal, but if you're way over it, it's going to draw a red flag and you potentially could be subject to audit. So now, again, I'll kind of get into more specific details on that. You know, so pretty much their IRS main goal for auditing is to recuperate money. So obviously the agent's got to spend time. They have to pay the agent in order to audit you. So their main goal is to recoup money. So they're looking for, any individuals that they're going to have the highest likelihood of getting additional money from them. So again, typically it's higher income earners and then people that also fall outside of those percentages. So kind of using this as an example, I'm going to say let's use a CPA as an example. So, you run a tax practice and maybe some bookkeeping, and you have a specified office that's not at your home. You have a, separate commercial location that you pay rent to. And you're claiming rent on your Schedule C. And then I want to go on ahead and also take my home office as a deduction. And I file that form and I take a home office as a deduction. That's going to draw a red flag because now the IRS knows that you have two places of business and that your home is not your principal place of business. They're automatically going to say that third party location or that location that's off site, that is your principal place of business, and therefore your home office deduction is excluded. Now, regardless whether you have receipts or whatnot, they're going to exclude that because you've already taken rent expense. So in this particular case, again, kind of look out for those items. So I think that's something to keep in mind. And again, just like reasonable stuff too. So like anything that may resemble personal expenses, you want to make sure you're leaving those off. And then again, it's very important to make sure that you're maintaining records. You must prove to the IRS that it was a business expense and that it's reasonable. Now, again, you want to maintain those records for a minimum of 3 years, as the IRS can come back and say, okay, prove it to us at any point in time. So the records are really just for your own sake in the event that you get audited. So I always say keep them in a box, keep them by a year, so that way you have it, or keep it in an electronic file if that's something that you prefer. Nothing is worse than not being able to substantiate an expense, and therefore the IRS just saying, sorry, we're going to disallow that expense. But again, so hopefully you guys found this video helpful. Like and subscribe if you do. Leave comments down below, and happy to follow up on any additional questions that you have. But hopefully everybody found this video helpful.